Wow, what a huge audience. I'm so honored to be here. I'm honored that you are choosing to spend your lunch hour with me. Unfortunately, I don't have any food for you, but I hope to provide some food for thought, at least, as I go through this talk. Now, I started my career over a quarter century ago as a semiconductor analyst. So I was actually covering semiconductor companies during the original tech bubble of 1999 to 2000. And I was told in 1999 that demand was super strong for semiconductors as far as the eye could see, and that there was going to be a permanent change in the demand for semiconductor chips. That obviously wasn't the case, and I do think that when you've seen past cycles before, it gives you perspectives about the future. Now, today I'm not going to go into individual companies, but I will speak more about how to think about investing in global equities, including technology, at a time when there are concerns about bubbles once more. And I'm also going to play with you something of an investment game. So please be prepared for that. I hope you'll participate with me when the time comes. Now, when we think about global equity markets last year, they were very, very strong. If we look at how they did in US dollar terms in particular, Europe did the best. If we look at it in local currency terms, it was really about emerging markets. And actually picking up the rear has been, as you can see on the bottom left, the S&P 500. That's the benchmark, right, of the US equity market. But that was actually a very unusual circumstance, right? If we were to look at this chart over 10 years, over 15 years, the S&P 500 would easily be at the top. So why did this happen? Why did the US, given its many attractive companies, including in technology, pick up the rear for performance in 2025? Well, there is a little bit of a backstory to this about why the US has been so strong for so long, and that is really its incredible quality. And there's lots of ways of defining quality, but when it comes to investing, quality means profitability. And what we find is, as we can see in this chart on the left, the technology weight within the S&P 500 or the US equity market has gone from 10% to almost 45%. And if we look at the profitability of those tech companies in the US, they've gone from being pretty low in terms of free cash flow margins, right? They've gone from roughly less than 2% in 1994 when I more or less started my career, to 2024 where those same free cash flow margins were above 16%. That's unusually high. Anyone here that's run a business knows that if you have free cash flow margins that are that high, you've got a fantastic business. And because the US market has much higher margins, it's more profitable than other markets, that's why it has outperformed. And more to the point, those tech companies have become less cyclical, and they've also delivered profitable growth even in times when other parts of the global economy may have been in an earnings recession. And so that US outperformance over 10 or 15 years has been driven by higher profitability. But here is the key question. Has that cash flow profitability peaked? We all have heard, I'm sure in this room, of the Magnificent Seven, of those 7 very large companies in the US that have delivered very, very strong and profitable growth. But here's the interesting element about that Mag 7 cohort of mega cap technology firms. Their net profits continue to grow, but the free cash flow that they're generating has actually been coming down. Why is that? It's because of what you see on the right. Most of those companies, those mega cap tech companies in the US, as you can see on the right side of the page, have been investing very, very heavily into new data center capacity to fund their AI investments. And here's the thing, they're not mostly making money directly from AI. They're investing to really defend their existing businesses. And you see the names of all of these on the bottom right. Now, I don't know about you, but what I loved about these companies 5 or 10 years ago was that not only were they very profitable, but they were asset light. They didn't need to invest a huge amount into capacity. But this is changing. Today, the capital intensity, the amount that these companies are having to spend on new investments is almost like an oil company. And we do worry that the profitability of these companies have peaked. They will still keep growing, so that's why we need to own some of them, but we do wonder whether or not other companies will see profits grow faster. There's another element to the Mag 7 phenomenon, to this big tech phenomenon taking over the investment world and, essentially global equity markets. And this is the chart on the left. What this is showing you is that the S&P 500, which people used to think of as the safest market in the world, has become a lot more volatile over the last 5 years. What this is telling you is that the US equity market compared to other developed markets is now 1.6 times as volatile. And this is because it's dominated by just a few companies that are very crowded trades. And what we also notice is that when we look at this chart on the right, we find that the earnings growth of the Mag 7 used to be hugely dominant against the non-Mag 7 US equity market. And it's also been hugely dominant against other markets around the world. MSCI EAFE is just another way of saying developed equity markets that are non-US. But if we look at the second half of 2026, what we find is that the earnings growth expectation for the Mag 7 is converging with the rest of the US and everything else. And that tells us that instead of being in only very crowded AI trades, you've got to balance your exposure and own other things. And that is the point that we're trying to convey today. What is also interesting is that people have thought of the Mag 7, of big cap tech, as being the new defensives as well as the new offensive companies. They're the companies that can do everything, right? They grow faster than the market and they deliver earnings even when other people are not. And so they're defensive and offensive. And that's true, but here's one problem with them. They're expensive. They're actually very expensive and they're also volatile. So you need to manage your exposure to this large cap tech group very carefully. And what we find is that low beta or stable stocks is actually very cheap today versus history, as you can see on the left. And price to free cash flow or quality valuation metrics are also cheap today. So we can buy companies that are not so volatile, that are high quality, and also that are cheap on that cash flow at bargain levels. And where we find these, especially as you can see on the right, are in defensive sectors, whereas tech and consumer discretionary names are expensive versus history. So I didn't say that we shouldn't own AI winners. That's not my message today. What I am saying is that we need to strike the right balance in our portfolios to get that balance right between return and risk, between volatility and return. And we think that we need to especially be careful because there are a number of risks as well as opportunities in the marketplace today. We have to worry about the Trump factor. Are there more upside opportunities or downside risks? We need to think about the Mag 7 and tech. Is there still more to come in terms of performance? Or is it already mostly in the price, right? And so getting that balance right is important. And then lastly, we don't know what the medium to long-term effects of tariffs and other things are going to impact inflation and what is happening at the Federal Reserve and how that's going to impact equity markets as well. So a lot of unknowns. And when there are unknowns, we find it's better to manage your portfolios by taking the high road, taking higher quality, but not overpaying for that quality, to focus on valuation and on stability as well. And when we take that quality, stability, and price way of thinking about markets to technology, what we find is that historically semiconductors have been the most volatile and the most cyclical part of the technology market. People love it today because they think that this AI CapEx boom will never end. But I've seen a few cycles before, and I know that's not going to be the case. There will be cycles again. We don't know exactly when it will turn, but we know that if you're building a portfolio for your retirement, for the long run, you've got to be more selective with your AI exposure. And what we find is that the companies over on the right side of the page are just simply less likely to see earnings cycles. They're less likely to fundamentally disappoint you. And actually, a lot of them, especially the ones that have proprietary data sets, they may be long-term AI winners that use this new AI technology. A lot of the AI winners we've seen in the last few years have been enablers or capacity providers or tech providers, but they may not be the ones that win using AI. And so we just spare a thought and space in your portfolio for that as well. When you focus on what I just said, which is high quality, stable companies purchased at the right price, this strikes the right balance, we think, between offense and defense. And what we also find is that we find unexpected sources of defense in offensive sectors like tech and also in financials, right? Think of an insurance company that is improving their shareholder returns in Europe. That sort of company will probably attract more interest from investors and do well even if the macro cycle isn't doing that well. And similarly, we find unexpected sources of offense in defensive sectors like healthcare or consumers. What I'd also remind everyone in this room, I know lots of you love your income solutions, your fixed income, but we don't know what is going to happen to inflation over the medium term. And what you see here is over the last 100 years, and I'm using a US equity data set here because US equities have the longest history. When inflation is between 2 to 4%, you get much stronger real returns from equities over everything else. And that's really why you have to stay invested in equities for the long run. So really the question is how you do it, because we also know the longer we stay invested in equities, the better the outcome. On any given day, whether you make or lose money is a coin flip. But over 10 years, you have a very small chance of losing money because the longer you stay invested, the better you do. And actually, if you were to look at this same number over a 10-year period with a high quality or profitable portfolio, that number is 99.5% that you're going to make money. Here's the thing though, why do many of you in this room prefer fixed income? It's probably loss aversion, not wanting to lose money. And we often let that fear of loss drive our investment decisions. And it's very interesting, we've seen long-term studies done on investor behavior. The one that is most quoted is called the Dalbar study. And even though US stocks have typically delivered 10% annualized returns, right, most average US stock investors have only made 5. Why only 5? It's because people tend to buy and sell at the wrong time. And so what we need to do to capture that benefit of owning equities and to protect ourselves from inflation is to make sure we invest in equities in a way that allows us to sleep well at night so that we can stay invested for the long run. And this is where, as I mentioned, we're going to play a game. So I'm going to ask all of you in this audience, I hope you can see the screen, to choose one of these two doors, okay? Behind door A, you have an 80% chance of getting $4,000, okay? But behind door B, you have a 100% chance of getting $3,000. How many of you would prefer door A? Please put up your hands. Okay, there's definitely some math experts in the room that understand expected return. But how many of you would prefer door B? Okay, definitely more hands up in this room. Now, as I said, I'm sure all of you in this room have done probabilities before. You know that the expected value is better behind door A. But you know what? A Nobel laureate, the late Daniel Kahneman, who wrote a fantastic book I'd recommend to you, by the way, called Thinking Fast and Slow, he found in prospect theory that people much prefer door B because people naturally gravitate to the sure thing. But let's take another insight that the late Daniel Kahneman came up with and play this second part of this game with me, okay? Behind door C, we have an 80% chance of losing $4,000, but a 20% chance of losing nothing, okay? Behind door D, you got a sure loss, 100% chance of losing $3,000. We all know the math already, we've done it already, but how many of you would prefer door C? Okay, quite a lot of hands up. How many of you prefer door D? Okay, those are the very small smattering of rationalists in the room, okay? Yes, we'd all like to perhaps not participate in these moments, but even though the expected value is worse for door C over door D, almost all of you preferred door C to door D. And you know what? Daniel Kahneman found in his studies that 92% of people preferred door C. Why is that? It's very simple. We are all hardwired as human beings to be risk averse, but we're even more hardwired as human beings and as investors to be loss averse. And what prospect theory found was that we feel the pain of loss 2 to 3 times more than the pleasure of gain. This is a very profound insight into what kind of equity strategy you may want to consider, knowing your own nature as an investor over the long term. Why do I say that? Well, we designed our low volatility equity strategy at AllianceBernstein specifically for this reason. We know you want to participate in rising markets, but you also want to mitigate loss in falling ones. And so we've built a strategy that not only over the course of the time we've been running it since 2012, but using data going all the way back to 1970, we found that a high quality, stable portfolio that is disciplined on cash flow delivers 90% upside capture in rising markets and 70% downside capture in falling markets. In other words, we feel that many people would be willing to give up 10% of their upside in rising markets as insurance if they got 30% crash protection in falling ones. And what that also means, since we know equity markets go up over the long run, when markets stop falling, you start from a higher base. And that's why a strategy like this works. It's also why you can sleep better at night with your equity exposure when you invest with a low volatility equity mindset. And we also feel that low volatility equity, with its focus on quality, stability, and price, is able to address the key risks of markets today. Quality addresses inflation risk, right? When you're running a quality business, you can charge the prices that you want, and you can offset inflation. Stability helps you manage earnings risk, right? You want stable companies that generate profits and profitable growth regardless of where you are in the economic cycle. And last of all, you mitigate crowding with price discipline. And by the way, these days, certainly in the last several months, we found that those high-flying AI winners, quote unquote, they've been much more volatile than the market. We feel getting the balance between AI and non-AI names in your portfolio is critical to your success. And we look at companies globally. We think that's important to find not only high-quality, stable companies at the right price in the US, but outside of it as well. And we have analysts around the world scouring markets all over for new ideas. And you can see that we have been able to deliver attractive returns, and importantly, that 10% that we've delivered since inception, annualized in 2012, has come with a lot less volatility than other global strategies or markets. So I'll stop there. Thank you so much for your attention, for spending your lunchtime with me. I hope I have fed you in terms of your future portfolio outcomes. Thank you.